Hey, good morning, guys. Welcome to Market Monday. So I'm gonna give you guys a quick update on everything that happened last week and what's gonna be coming up this week that could really change or help mortgage rates on this amazing path we've been on. So before we get right into it, I'm gonna do a quick dad joke. Dad joke today is I got some anti-gloating cream a few days ago. I can't wait to rub it in. Get it? Pew pew pew. Anti-gloating clean cream. Can we throw it in? All right. So getting right into it. Last week was some really big news about what the Fed was going to announce in regards to the Fed rate cuts. Now, there wasn't a whole, outside of that, there wasn't a whole lot of extra stuff except that Jackson Hole meeting. So what they did is after that 2-day meeting on Friday, they announced that they plan to do a Fed rate cut in September at the September 17th meeting. Now, the reason why they're not doing it now and waiting until September is because one, it's going to be after the jobs report in a week or two, because that's going to have a really big impact on how the economy is going. So they're kind of setting up the stage right now. It's like, hey, we plan on cutting in September, depending on how the September jobs report comes out. Now, with the new head of BLS being installed, they do hope that the reports are going to be a lot more accurate now, and they're going to be showing the true sense of where the labor market is at. Because honestly, we're still over 1.97 million people who are still filing for continuing claims. Continuing claims means they're still filing. These are people who've gone past the initial claims for unemployment. Now they're there at their second, third, fourth time, still continuing claims for their unemployment benefits, which means they haven't been able to find a job. That's really unfortunate. But this number keeps going up, and it stayed up this high since mid-May. So with everything we've seen, even the amount of the initial claims have gone up, continuing claims continue to go up, and we're probably going to get pretty close to 2 million, if not potentially break 2 million people who are still filing for unemployment benefits. So what does that mean for the BLS jobs report? There's a very strong chance that we're going to see the unemployment rate still go up. And that's what we're expecting to see. And that's why they're waiting until September 17th to decide if we're going to raise if we're going to cut the Fed funds rate. They haven't decided about how much. Maybe it's 20 point quarter of a percent or a half a percent, but they do intend on cutting those rates again. Now, in response to that, what was nice is that rates actually improved a little bit last Friday, and it wasn't a big improvement. When we say it's 25 bips or 30 bips, it's basis points. That's what it stands for. Bips stands for basis points, and it's not a very big percentage. It's 25 bips is about point zero. It's like 0.25%. That's really how small a basis point is. So it's not a huge change in regards to the overall rates. It's not like rates went down by a quarter percent. It's really that small of a change it's 1/100th of percent. So for you guys to look it up, it's a very small percentage of how big these changes are, but each change is a decent amount. So if we stack on these improvements and continued improvements, we start seeing the landscape of where we see rates go down to where we're right now, to the low sixes, to even the high fives. Now we start seeing the true path of mid fives, high fives is the range. So definitely it's getting in that range, and we're excited to see those numbers. We hope that the BLS jobs report and the jobs reports that we see moving forward match everything else we see in regards to all the other jobs reports, because BLS is the only one that disagrees, except for last month's BLS jobs report. So that's what's super exciting. Now moving forward into this week, the main thing that's going to be a big driver for rates is probably going to be the last inflation report for August. That is the PCE report on Friday, and that's the Fed's favorite measurement of inflation out of the other three. They just chose that, and that's what they decided. Now, what's unfortunate about that report is that they are expecting it to go up, which is fine, right? Because it's how the calculation works, and some of the replacement numbers over time, the average is going to go up. Now, how much it goes up is expected to go up by like a 0.1%. But if it doesn't go up as high, then that's a good sign for rates. If it comes in as expected, that's a good sign for rates. If it comes up a little bit more than expected, then we could see rates reverse and go in the opposite direction and go up. But the thing is, like, the Fed is also aware of that the tariffs is going to have an impact on that and on these inflation reports. So what we saw earlier this month as a sign is that it's CPI, Consumer Price Index, that did go up, but not by very much. But the PPI, which is wholesale inflation, did go up. That has a bigger that weights more on like how the tariffs are impacting our prices, because really the tariffs only impact the raw materials that are coming out of China effectively. So it's not the finished product. So it's not saying that, whatever the market price or how much you buy the item on the shelf is being tariffed. It's actually the item that's being sent over to be assembled here or created or brought together here or whatever it is. Because a lot of these items are, that you buy off the shelf, especially electronics, they're marketed almost 200, 300% more. So the tariff is actually on the whole cost item, which is an item that's maybe $100. Did you know it takes like 20, 30 bucks to make a smartphone? That's all it takes. And that's what's being tariffed, not the price. So most companies, they're like, it's dollars, right? For them, it's dollars. It's not, hundreds of dollars that they're losing. So it's a very small percentage that they're losing, but it's still something to keep an eye on when we're trying to like figure out what's the prices of goods that's going to happen. So we'll see. Now, otherwise, I mean, that's really about it. GDP is going to come out this Thursday. So that's going to give us an idea of how the consumers and sales are buying basically buying market, if people are buying stuff or not. So GDP is going to come out this Thursday to kind of see how quarter two is. Otherwise, that's about all I got for you guys today. There is some exciting landscape. Oh, before I end, I want to go ahead and show you guys what rates look like right now, so that way we kind of get on the same page. So this is what last Friday looked like. As soon as we heard that they intend on lowering the Fed funds rate, mortgage rates actually improved a decent amount, and now we're in this range here. So overall, we're still on the lower end of things. I mean, in the beginning of the year, we were up here in the low sevens and mid sixes and high sixes for VA and FHA. Blue line is conventional. So things are significantly better. We're hoping that the low point gets exceeded by this, which it kind of is already. So what's on the government loan side, it's not about conventional loans. This is the lowest it's been for the year for conventional rates. For government rates, it's almost there. So that's what's really nice about seeing these numbers, is that yes, there are some spikes, but this is expected. This is how the economy flows, but the overall trend is downward, which is a good thing. But that's all I got for you guys today. Hope you guys have a great week. Nuke out.